So if you had put, say, $30,000 into SanDisk during its spin-off just over a year ago, you would be sitting on over $1 million today.
Which is just, I mean, it's an absolutely insane number to even say out loud.
It really is. Welcome to this deep dive, by the way. Today, we're basically ripping apart the mechanics of what has to be the greatest momentum anomaly in the market right now.
Yeah, we are looking at the entire memory supercycle, the underlying joint venture risks, and the highly leveraged casino games Wall Street is currently playing with the ticker SNDK.
Exactly. But real quick, a reminder before we look at the blueprints here. This discussion is purely for entertainment purposes. It is not financial advice.
Right. Definitely seek professional advice before making any moves.
Yeah, which is especially important given the absolute whiplash we are about to cover. To get to the bottom of this, we've gathered a massive stack of sources for you.
We've got everything from financial media like The Motley Fool and 24/7 Wall Saint to an SEC prospectus for a leveraged ETF, and even SanDisk's own 2025 Investor Day slides.
So the big question, the mission of this whole deep dive, is trying to figure out, is this a flash-in-the-pan meme rally, or is this the start of a fundamental shift in the entire memory market?
It's the kind of whiplash that fundamentally breaks traditional valuation models, honestly. When a stock surges almost 600% year to date, it forces us to look past the top-line hype.
Right.
We have to figure out the actual physics of the underlying business. We're looking at a market environment where capital is flowing so aggressively into hardware that it creates these massive concentrated distortion fields.
And the focal point of that distortion field right now is absolutely SanDisk.
Yeah.
So, okay, let's unpack this. Let's trace it back to the catalyst, because the origin story of this run-up is almost as fascinating as the peak itself.
Oh, yeah. February 24, 2025.
Right, exactly. SanDisk officially spun off from its parent company, Western Digital. Western Digital had owned them since 2016, I think?
Yep, 2016. But this move brought SanDisk back to the public market as an independent, pure-play stock, focused entirely on flash memory and enterprise solid-state drives.
Which is a really critical distinction for institutional investors, right?
Huge distinction. Before the spinoff, if you wanted exposure to the booming enterprise solid-state drive market, you had to buy Western Digital.
Which meant you were also buying a lot of their legacy hard drive business.
Exactly. And the slower growth consumer storage stuff. The spinoff allowed the market to place a pure premium on the exact type of memory needed for modern data centers.
And place a premium they did.
Mm.
I mean, the price action we're seeing in the sources we gathered is staggering. Depending on the specific trading session you look at over the last few weeks, this stock has been violently oscillating.
Violently is the right word.
Yeah, it's bouncing between $1,646 and $1,822 a share. That translates to roughly a 594% surge just in the first half of 2026.
Just putting that into perspective, you have the S&P 500 grinding out maybe an 8% gain in that same time frame. SanDisk is operating in an entirely different gravitational pull.
But here is the detail from the sources that just highlights how unpredictable this sector really is.
Western Digital actually held on to a stake in SanDisk after the spinoff.
Right.
But they monetized it just to pay down their corporate debt. They executed a secondary offering at $545 per share.
Oh, wow.
Yeah, they completely missed this monumental run-up to the 1,600-plus range.
They treated it like a mature asset rather than the growth engine.
Right.
Western Digital saw an opportunity to clean up their balance sheet, and they just completely failed to anticipate the tsunami of capital expenditure that was about to hit the data center market.
So Western Digital cashed out early. But look, a nearly 600% gain in a year sounds like a roller coaster that's about to drop. We've seen tech hardware cycles run entirely on fumes and retail euphoria before.
Oh, absolutely.
So how much of this valuation is anchored to physical, structural reality versus pure speculative fever? Well, the skepticism is entirely warranted. But the data here tells a pretty compelling story about structural reality. Wall Street analysts are forecasting a 332% year-over-year revenue growth for SanDisk in the fourth quarter of 2026.
Wait, 332%?
Yep. And they are modeling another 118% growth on top of that for fiscal year 2027.
Okay, those massive revenue projections look insane on paper, but they actually start making terrifying sense when you look at what's physically happening inside the data centers.
Exactly. The easiest way to visualize this dynamic is the difference between the brain and the bookshelf.
Right. NVIDIA is shipping the processors as fast as they can make them, the brains of the AI revolution.
But those brains need somewhere to store the petabytes of information they are learning from. SanDisk is building the bookshelves.
Because without those massive high-speed solid-state bookshelves, the logic processors just sit idle.
Every single one of those AI processors requires an enormous, almost incomprehensible quantity of NAND memory. You literally cannot train a large language model if you can't feed it data at blistering speeds.
And the scale of this build-out is what's driving the panic buying. NVIDIA is telling investors that global data center capital expenditures will top $1 trillion in 2027.
1 trillion.
And by 2030, they expect annual global data center capex to reach between $3 trillion and $4 trillion. So everyone is frantically buying memory to hold this new infrastructure together.
And that frantic buying has completely altered SanDisk's profit profile. A year ago, their gross margin was a meager 22.5%.
Which is pretty typical for a commoditized hardware manufacturer in a normal cycle, right?
Very typical. But last quarter, that gross margin exploded to 78.4%. Data center revenue alone surged 645% year over year.
Going from a 22% margin to a 78% margin in a hardware business is almost unheard of. It means they essentially have absolute pricing power right now.
Yeah, the hyperscalers are so desperate for capacity that they're willing to pay whatever SanDisk demands.
And that pricing power is the direct result of a severe structural supply shortage. Right?
Exactly. You have to understand the physical realities of manufacturing 3D NAND memory. You can't just flip a switch and double your output because demand spikes.
Right, it takes time.
Building a new fabrication facility takes billions of dollars, immense amounts of highly specialized equipment, and years of lead time. Analysts covering the space don't expect this supply constraint to meaningfully ease before 2028.
Wow, 2028.
Yeah, the supply is inelastic, while the demand is parabolic.
That inelasticity is definitely the engine of the bull case. But here's where it gets really interesting. Reading through the 24/7 Wall-Street analysis and SanDisk's own Investor Day slides, there's a massive structural vulnerability hiding right underneath that 78% margin.
Oh, for sure.
If SanDisk is selling the bookshelves to NVIDIA's brains, it turns out they don't even fully own the lumberyard to get the wood. Can you explain the Flash Ventures situation?
Yeah, that brings us to Flash Ventures. This is a critical manufacturing joint venture that SanDisk operates with Kioxia, a Japanese memory manufacturer.
Let's look at the actual ownership split of this mega fab complex, because it's not a simple partnership at all.
No, it's complicated. The overall fabrication capacity is split 80% to the joint venture and 20% strictly to Kioxia. And within that 80% joint venture, the capacity is split 50-50 between SanDisk and Kioxia.
Which means SanDisk's entire production destiny is tied to a partner they do not fully control.
Exactly. In a supercycle, the single most important lever a company has is the ability to independently ramp up capital expenditures and optimize manufacturing yields to capture market share.
But they can't do that. If SanDisk wants to invest heavily in expanding a clean room or upgrading equipment to meet this AI demand, they have to get Kioxia to agree to match that investment.
Right, they are sharing the literal physical space where these chips are grown. When you're operating in a highly cyclical, cutthroat hardware market, relying on consensus for your capital expenditure timing introduces immense systemic risk.
And we should point out, competitors like Micron, the ticker MU, which is up 223% this year itself, they operate their own fabs.
Yep. They control their entire vertical stack. SanDisk is navigating this trillion-dollar build-out while essentially tethered to Kioxia's strategic priorities.
And that vulnerability is compounded when you look at the divergence in SanDisk's customer base. We've talked extensively about the 645% surge in data center revenue.
Right.
But looking at the sources, their consumer revenue actually dropped 10% sequentially.
Which is a glaring red flag. So while everyone is focused on the hyperscalers, their legacy business, the memory cards, the basic consumer hard drives, is actively bleeding pricing power.
It really exposes the fragility of the narrative.
Yeah.
The entire bull case for SanDisk, that $1,600 plus share price, relies unequivocally on the enterprise AI market continuing its aggressive expansion.
Because the consumer is pulling back, meaning SanDisk has no safety net, if the hyperscaler sector even temporarily pauses its spending, the impact on SanDisk's bottom line will be devastating.
Yeah, if you're holding this stock right now, the metric you should be absolutely terrified of isn't necessarily the broader macro environment. It's the customer concentration risk flagged in the sources.
Yeah, that's the big one.
One single customer currently accounts for over 10% of SanDisk's total revenue. And their top 10 customers make up 46% of their net revenue.
It's a classic bottleneck scenario. If just one of those top 10 customers encounters a delay in securing power for a new data center or decides to aggressively dual source their memory from a competitor like Micron or Samsung, the revenue hit is immediate.
Right.
You are placing a massive premium on the assumption that these 10 clients will never alter their procurement strategies.
And Wall Street naturally is looking at all of this.
Yeah.
The 600% gains, the Kioxia risks, the reliance on a handful of mega-cap tech giants, and they're deciding that what this situation really needs is a leveraged casino product.
Of course they are.
Let's dig into the SEC prospectus we gathered for the trade 2x long SNDK daily ETF. The ticker symbol is SNXX.
This is where financial engineering basically preys on retail momentum. Because SanDisk's share price is hovering in that inaccessible $1,700 to $1,800 range, this ETF is executing an 8-for-1 forward split in June 2026.
But the goal there is purely psychological, right? It doesn't change the underlying value of the assets one bit. It just makes the share price look cheaper, so a retail trader with a smaller account feels like they can jump in.
Exactly. But what they're jumping into is a vehicle tied to a stock with an annualized historical volatility rate of 93%.
93%. Let's talk about the physics of that volatility inside a leveraged fund. This ETF is designed to provide 200% of the daily performance of SanDisk's stock.
The key word there is daily.
Yes. And this is where people get absolutely destroyed. They think, oh, SanDisk is a great long-term AI play, so if I buy a 2x ETF, I'll just double my long-term returns. But the SEC prospectus explicitly warns against holding this.
Think of a leveraged ETF like a boat with a leak. If the water, the market trend, is perfectly calm and moving fast in one single direction, the engine outpaces the leak. You make great money.
But if the water gets choppy?
If it gets choppy, that daily resetting math means your boat is taking on water every single night, even if the stock itself ends the week exactly where it started. The mechanism driving that leak is compounding decay.
Which is sometimes called correlation risk in these prospectuses.
Right. Because the fund has to guarantee a 2x return every single day, the fund managers have to rebalance their derivative positions right before the market closes. If SanDisk drops 10% today, the ETF drops 20%. If you started with $100, you now have $80.
And if SanDisk bounces back the next day?
To get back to your original $100 from $80, you don't need a 20% gain. You need a 25% gain. The fund is structurally forced to buy high and sell low purely to maintain its daily leverage ratio. If SanDisk's stock trades sideways, bouncing violently up and down in a 93% volatility range over a few months, the 2x ETF will actively bleed your principal away to nothing.
It is designed for single-day trading, not for long-term holding.
Exactly. Not for participating in a multi-year supercycle.
So, okay, we have a heavily hyped underlying stock, extreme volatility, and derivative products actively pouring gasoline on the fire. So what does this all mean for your portfolio? How do we make sense of the actual value here? Let's look at the valuation multiples from the financial coverage.
Yeah, the numbers require some serious context. At the time of this coverage, SanDisk's trailing PE ratio is 53, the forward PE is 27, and they are trading at an EV to EBITDA multiple of 48.
An EV to EBITDA of 48. For a cyclical hardware manufacturer, that isn't just a premium. That is pricing in absolute uninterrupted perfection for the next 5 years.
Right. We were talking about a company that has to spend billions on physical depreciating assets just to stay relevant. Pricing a hardware company like a high-margin software-as-a-service business is incredibly dangerous.
And a forward PE of 27 basically implies that the market believes the historical boom and bust cycle of the memory industry has been permanently suspended.
It assumes the 78% gross margin is the new normal, rather than a peak cycle anomaly caused by a temporary supply shock.
Wall Street is overwhelmingly bullish on paper, though. Out of 22 analysts covering the stock, 15 have it as a buy, 3 rate it a strong buy, 3 say hold, and only 1 has the nerve to rate this a strong sell.
But there's a fascinating catch in the data. Their consensus price target is $1,659.27. The stock is frequently trading above their consensus target.
The momentum is completely decoupled from the analytical models.
Right.
When we look at the internal valuation models from these analysts, they peg SanDisk's fair intrinsic value at $1,455.29.
Right. Meaning the math, the actual projected cash flows of the business discounted back to today, says the stock is fundamentally worth about $1,455.
Compared to a trading price of $1,646, that represents an 11.62% downside just to return to baseline fair value.
The market is paying a massive premium purely for the momentum and the AI narrative.
And what happens if the music stops?
Yeah.
If one of those top 10 customers delays a data center or Kioxia refuses to match a capital expenditure?
The absolute bear case modeled in these reports sits at $1,029.35.
Ouch.
Yeah. If the supply-demand imbalance normalizes faster than expected, or if consumer weakness drags down the blended margins, there's a very deep floor to fall through.
That would be a brutal haircut for anyone buying at the top today. Based strictly on the financial coverage provided, the sources draw very clear lines in the sand for investors navigating this. At $1,540, the stock is categorized as a hold.
Right.
If it drifts up to $1,562, the model's flipped to a sell.
And at $1,646, where it has been trading, it is considered fully valued and deeply concerning due to the severe premium it commands relative to its intrinsic value.
So the final verdict from the analysis is pretty definitive. Despite the very real multi-trillion-dollar AI tailwinds pushing the industry forward, SanDisk's current price is heavily driven by momentum and retail euphoria. The explicit caution to investors is to avoid buying at this premium.
The risk-to-reward ratio is just skewed heavily to the downside when you factor in the Kioxia dependency, the extreme customer concentration, and the assumption of permanent 78% margins.
Because cycle math eventually catches up to hardware stocks, no matter how exciting the narrative.
The fundamentals always win in the end. A company can only expand its margins so far before competitors catch up, before the hyperscalers leverage their own massive scale to negotiate lower prices, or before the joint venture dynamics physically limit production output.
Investing isn't just about finding a company benefiting from a massive technological shift, right? It's about finding that company at a price that leaves room for human error. Right now, the sources suggest SanDisk is priced for a flawless future, and hardware manufacturing is rarely flawless.
Before we close out, there is a broader systemic implication here worth considering. We keep talking about this massive, completely unserved market for data storage. But if the physical complexities of fabricating 3D NAND memory are this severe, will the sheer limitations of building these megafabs become the actual bottleneck that slows down global AI development?
Wait, that's a great point. We spend so much time obsessing over the companies designing the AI brains.
Yeah.
But if you literally cannot manufacture enough physical space to store the intelligence, the revolution just halts.
It forces you to wonder if these legacy memory manufacturers, the ones with the established foundries and the joint venture mega-complexes, will eventually wield as much geopolitical power as the chip designers themselves.
That is a fascinating and sobering thought to leave you on. If you're looking at that massive mountain of casino chips that materialized overnight with SanDisk, remember, the house always knows exactly what those chips are mathematically worth. Don't let the height of the stack blind you to the structural realities of the game. Thank you for joining us on this deep dive. Keep questioning the hype, keep looking at the underlying mechanics, and we will catch you next time.